Hello, ladies and gentlemen. Thank you for standing by and taking the time to join us for today's webinar, Retirement Plan Options for Dental Practices. My name is Dan Vors, and I will be your moderator. For those of you who may not be familiar with us, CliftonLarsonAllen is a professional services firm with three distinct business lines, including accounting and consulting, outsourcing, and wealth advisory. We have 3,600 staff members with offices across the country. Without further delay, I would like to introduce today's presenters. John Stiglich is a principal for CliftonLarsonAllen Wealth Advisors, LLC, and is responsible for managing the firm's Employee Benefit Services Group. He has been serving privately held businesses for more than 33 years and is passionate about providing clients and their employees with customized retirement plan designs and investments that will help them reach their retirement goals. Tim Childers is a healthcare principal at CliftonLarsonAllen with more than 20 years of experience serving healthcare clients. He has extensive experience in advising and assisting clients in the areas of corporate, partnership, and individual taxation, as well as general business consulting. Before I turn it over to our presenters, I'd like to go over today's learning objectives. At the end of the webinar, you'll be able to understand the impact of recent tax changes on your practice, understand how tax changes may affect how you establish and fund your retirement plans, and evaluate which type of retirement plan is best for you and your practice. Let's move forward with the presentation. John and Tim, I'll pass the mic over to you to get us started.
Thanks, Dan. I appreciate the opportunity. This is Tim. Quickly on the agenda, which you'll see on your screen, what we really plan on talking about and hitting hard today are understanding why retirement planning is more important than it has ever been. We want to talk a little bit about some of the new tax obligations that have gone into effect for this filing season related to the Affordable Care Act. We want to talk a little bit about some retirement plan selection criteria, what plan is right for you, and compare and contrast the various retirement plan options for your practice. Retirement planning. I sort of look, in my experience, I've sort of looked at retirement planning as a little bit of like looking into a crystal ball. And as we all know, sometimes that crystal ball can look a little bit fuzzy, but there are some things that you can be certain of and plan around. Those things would be, some statistics here say that really less than half of the companies with less than 100 employees offer retirement plans, and less than 30% of the dentists are maximizing their retirement plan contributions. And understanding that shortcoming in terms of what's being offered to folks for retirement plan purposes dovetails into these future realities that I think we all understand. Statistics say we're living longer. Statistics certainly say that there are rising costs of health care and long-term care. I get the question all the time is, Tim, should I be planning on Social Security at retirement? And the concern there is, decreasing government benefits. And once again, the other issues relate to steady inflation. So all of those things add up to the fact that we think it's more important than ever to build that nest egg and plan for your future. 3 myths about retirement plans. Having done this for a long time, these are the 3 things that I hear most often from my dental clients and other healthcare clients. First, the first comment is my practice will subsidize our retirement. And I think this was very true, certainly early in my career, where the dentist would work their career, get to the retirement age, sell out, and sort of ride off into the sunset. And I think the concerns these days about the ability to sell, who's going to buy, who am I going to sell it to, raise some real issues about the ability of your practice to be a big player. So I think you need to plan for all kinds of potentials. The second piece is I can't afford a plan, and I think we'll go through some examples today that say I think that's an issue that can be easily overcome. And then finally, employees want more money in their paychecks, not in benefits. And while I think there's some truth to that as well, I think once again some of the examples we show here today, there are lots of scenarios where it almost looks like you're better off giving money to your employees than it would be to give it to the government in the form of additional taxes. Some other issues about why retirement plan is important. First of all, it's a method to protect your assets from creditors. Those assets that end up in these retirement plans, qualified retirement plans, are protected from your creditors should something happen. We think it's a great way to attract and retain top quality staff. We hear from our dentists all the time one of their biggest challenges is being able to hang on to, recruit, retain talented people in their group. It's a way to reward staff loyalty and longevity. And then finally, we'll talk a little bit about taxes, and more taxes as we understand the implications of the Affordable Care Act on all of our clients. The Affordable Care Act tax planning, as I said, there's a slew of new taxes coming into effect for 2013 that will be impacting a significant number of us for the coming filing season. First of all, there's a new top marginal tax rate at 39.6%, which, the note underneath there says in a lot of cases, a lot of taxpayers are going to see their effective marginal rates be more than 50% in a lot of cases. We're seeing coming back into play the phase out of your personal exemptions, so the deductions for yourself, your spouse, and your children may be limited. We're seeing the reacting of the itemized deduction phase out, which makes your home mortgage interest, your property taxes, other itemized deductions potentially less valuable from a tax perspective. There's this brand new thing called new net investment income tax, which is a way to tax, for some taxpayers, their interest, dividends, and other passive activities. There's a new Medicare tax on top wage earners of 0.9%. And then finally, the real question is, what about new capital gains taxes? You hear it's 15%, you hear it's 20%, and the answer to that is it depends. But clearly, for most folks, those capital gains investment strategies are seeing their taxes increased. John, you want to talk a little bit about some of the plans that we implement here at CLA?
Absolutely. And while I do that, I see our first polling question is up. So for those of you that are interested in the CPE, you're required to complete the polling questions as they pop up. So I'd ask you to please go ahead and do so. This slide kind of indicates the various retirement plans that we'll be discussing today, and they kind of align in a particular order from probably the easiest and smallest deduction up to the more complex and largest deductions. As you can see, we start out with the individual retirement account, the IRA, and then we're going to talk a little bit about simplified employee pension plans, more commonly known as SEP plans. Then we're going to talk about the simple IRA. Then we're going to move into the larger qualified type plans with a discussion on traditional profit-sharing plans. Then we'll talk about 401k plan designs, both the safe harbor and non-safe harbor variety and what the differences are there. And then we'll end the conversation on defined benefit plans with a discussion on cash balance plans in particular. So I talk about individual retirement accounts, an IRA account as being a retirement plan for a dental practice or for any business for that matter. And you kind of think about, well, no, that's something that an individual does. Well, yes, it is, but depending on I guess where the practice is in its longevity, this may play into the design of a particular dentist. If you're a young dentist getting started in the practice, you know the need to put some money away for retirement because we all know it's the first dollar invested that makes the most for us due to compounding over our lifetime. So one of the ways to maybe get started with at least getting some money set aside is establishing an individual retirement account. As you know, it's an account that you set up yourself as an individual. One of the nice things about it is you do not have to cover any employees in your practice for setting up your own IRA. The current contribution limit is $5,500, and if you're 50 or older by December 31st of this year, you can add an additional $1,000 as a catch-up for a maximum contribution of $6,500. Now, the IRA accounts can be deductible. The contribution could be non-deductible, or it can be Roth, which is a non-deductible version. With the Roth, any earnings that accumulate in the account, when it's distributed, if you meet the distribution rules, would come out non-taxable. There are certain income limits that come into play to determine whether a IRA contribution is deductible or non-deductible, and then it also would be dependent upon whether you are married and whether your spouse is covered by a retirement plan. But for the most part, I would think in most cases your IRA contribution would be deductible. Income limits also apply to Roth, So it's possible you may or may not be able to utilize that type of a vehicle. They're easily established and can be established up to the due date of your return, including extension, and typically a very nominal startup cost depending on where you establish the IRA. There may be some type of an initial fee and then a ongoing annual maintenance fee, but generally fairly minimal. Kind of the next step up the ladder is the Simplified Employee Pension Plan, or SEP account as we call it. This must be established by the business entity that is sponsoring the plan. And that's a critical thing, because we typically, in any given year, get, it seems like, a multitude of questions or issues that we have to try to resolve, where we'll have a small practice say that there are two partners in it, and one partner wants to make a contribution to a SEP plan to help shelter some of their income from taxes, yet the other partner does not want to do that. So the one partner will get his K-1, go down to their local bank or broker and say, here's my self-employment income, I want to establish a SEP, and unfortunately some people, not knowing better, will go ahead and establish a SEP on that. Unfortunately, you can't. It's got to be sponsored, it's got to be established at the sponsorship level. So if there is a partnership in effect, it must be established there. Just by the mere fact that you have a K-1 with self-employment income does not mean that you yourself can establish it individually. So the entities that typically have to establish it would be the corporation, and a limited liability company, whether it's taxed as a corporation or as a partnership if you're in a partnership, or in those situations, if you're practicing truly as a sole proprietorship, then obviously you'd be establishing it in the name of your practice, but as a sole proprietor. As far as eligibility of the employees that you must cover all employees that are earning at least $550 during the year. However, you may require those employees to work up to 3 years before they are eligible to participate in the plan. Another area of caution is with this rule. We run into various instances where a new practice is established and they want to set up a SEP account, and in fact go ahead and do that, but they know that they may be hiring some employees in the relatively near future, and they X the box that says you got to work here 3 years before you're eligible to participate in the plan. Whatever that eligibility criteria is when you establish the plan holds true for everyone, including yourself if you're the owner. So you potentially could exclude yourself from the plan by not checking the appropriate box. The best way in a new practice to get to utilize the 3-year rule is that you initially establish eligibility criteria that you can meet, and then each year you amend the 5305-SEP form that establishes the account and tick it up 1 year till you get to the 3-year period. That way you can ensure that you would always be eligible to be in the plan, and eventually only those employees that work there for 3 years as you hire new employees would be eligible. So you can kind of work your way up to that rule, but you can't initially start there unless in fact your practice has been established for that period of time. The contribution that goes in is a maximum of 25% of your wages if you're drawing a salary from the business, or if you're self-employed, it's 25% of your net self-employment earnings. The contribution must be allocated proportionally, and that's another problem that we run into with small practices, where once again, especially it seems to be in the partnership arena, where one physician may be a little bit younger, have children in college, be saving for that, still maybe paying off some student loans of their own, have very limited funds to be able to put into a retirement plan, while the other physician may be looking at trying to maximize or shelter the maximum amount. Unfortunately, the contribution does have to be allocated ratably. So what one partner gets, the other has to get as far as a percentage of their earnings. So once again, in those scenarios, there may be another type of plan that would be more appropriate. The contributions are funded into individual SEP IRAs for each participant. Once again, these must be established by the due date of the tax return, including extensions. So for 2013, it's still possible to establish a SEP account for your practice, if that would make sense. And typically, similar to an IRA account, there's nominal setup costs, and there's typically some type of nominal annual fee that would have to be paid. There are no other filing requirements or testing required with these types of plans. Then we move over to a simple plan, which is basically a plan where you can have the employee now participate in their own retirement in the form of salary deferrals. Once again, this must be established at the business entity level as far as the sponsorship of the plan. You must cover all employees that have earned at least $5,000 during a year. Similar to the rules of the SEP, you can exclude employees that have not worked there for up to 3 years, but once again, you have the same issues relative to making sure that as you design the plan, you don't exclude yourself. And one key element on this slide that's not here, but you typically don't run into in dental practices, is there's a limit of a maximum of 100 eligible employees. If you go beyond that, then you're no longer eligible to sponsor a simple plan. The employees and yourself can defer up to $12,000 into the plan on a pre-tax basis. If you're 50 years or older, at December 31st, you can make a catch-up contribution of up to another $2,500. Then the company is required, or the practice is required to make one or two contributions. You either have to make a matching contribution equal to 100% of the deferrals made by any of the employees covered under the plan, up to a maximum of 3% of their pay, or you must make a flat 2% allocation in the form of like a profit-sharing plan to all eligible employees, whether or not they have deferred into the plan. Once again, contributions are funded into a simple IRA. If you do not have a simple plan in your practice at this time, you have up until October 1st to have it established and to have contributions flowing into the plan. A simple plan must have at least a 3-month plan year. It must be on a calendar year basis. Once again, there's typically a nominal setup cost to establish these. There's no annual reporting or disclosure fees, and there may be a nominal annual fee. I see that we have another polling question up, so once again, those of you that are looking for CPE, please answer the question. Some other things about a simple plan is that no other plan can be in existence either at the time that the simple plan is established. So if you have any other type of plan in place, like a SEP plan or a profit-sharing plan, you cannot establish a simple in that same year. Nor are there any ways to terminate a simple plan mid-year. There are no regulations that deal with unwinding a simple plan partway through the year. So if you establish a simple plan for a particular year, you're locked into that plan up through the end of that year. The critical date here is November 1st, because that is the date in which you must send a notice out to the employees indicating that you're going to have a simple plan in place for the following year and the method in which you're funding it, whether it's the match or the profit sharing. So with these rules, and we see this come up quite often when we help analyze a client's situation and determine that a simple plan is just not getting enough deductions set aside for the owners of the dental practice, and they want to maximize it into another design, and we find another design that's more appropriate. However, if they've already sent out that notice on November 1st for the following year, they're locked into that plan for another year. So, for example, this past December, we ran a couple analysis and found other plans that would make more sense. Unfortunately, it was past the November 1st deadline. These clients already had sent their notices out, so they were locked in for 2014, but surely are going to get lined for 2015 to change the type of design. So it's a critical thing. If you're thinking that perhaps you'd like to investigate some of the other plans that we're going to discuss here today, where you can get a higher amount of deduction, time to get things rolling now so that you don't go past this November 1st critical date. Tim, back to you.
Great, thanks, John. I think you described it pretty well. I think as we move up this ladder, as John described it, you're seeing some things come true, and that is one is typically the contribution limits are going to grow. Typically there is a little bit more complexity, but more importantly, there's a lot more flexibility. So hopefully you'll see some of that as we run through these examples. As we step into the example of a profit sharing plan, as John described in other plans, it's established by the business entity, the corporation, the S-Corp, the LLC, the Schedule C sole proprietorship. This one's a little bit different that it must cover all employees age 21 or older. It may require that employee to work for up to 2 years. Once again, not required, could be less. The company contribution is discretionary each year, so you can make a contribution for 1 year and not for the next and reinstitute for the following year. Once again, you see some of that flexibility there. There are several allocation options that exist for the contribution, so it may not just be a flat percentage of everybody's pay like you've seen in some of the other examples. There's typically a vesting schedule that applies to the profit sharing balance, meaning that employees have to stay with you for a given period of time in order to take that money with them if they were to leave. The contribution is funded into a separate plan trust, so it's a completely separate entity that, so to speak, that is the holder of the funds. Those contributions or those plans must be established by December 31st. So once again, if you were trying to do that for the 13 plan year, we've passed that, but as John said, if you want to be looking ahead, those plans have to be established by December 31st. The initial plan document, and once again, from a fee point of view, there's typically costs associated with setting up an initial plan document, plus some annual administrative fees that apply as you move forward. From a 401k profit sharing standpoint, this basically takes the profit sharing plan and adds on a 401k feature, which is the easiest way to think about that in my mind is allows employees to do their own salary deferrals. So once again, it's established by the business entity. Same kind of rules must cover all employees age 21 or older. May require employee to work up to 1 year. So once again, it could be up to a 1 year waiting period. Employees may defer up to $17,500, and once again, those employees who are over the age of 50 or have attained the age of 50 by the end of the year could contribute an additional $5,500 of deferrals from their own compensation. The company profit sharing contribution is discretionary. Once again, could do it 1 year and pass on it the next, and vice versa. Great deal of flexibility in these plans with several allocation options in terms of who gets what and what contributions are made for the ownership group versus for the rest of the general employees. Similar to the profit sharing plan that we just talked about, the contribution is funded into a separate plan trust that is participant directed, so each employee can have some say in how their dollars are invested. And once again, as we described in the previous one, it must be established by December 31st to be effective for that year. A couple of other sort of nuances that are available in the 401k profit sharing plan. First of all, the non-safe harbor. Normally it's a situation where you're offering an employer match. That matching contribution, once again, can be discretionary, and typically the vesting schedule to those employees would apply. The theory is, from the non-safe harbor standpoint, is it must pass actual deferral percentages. So in other words, you have to take a look at what the ownership group is deferring out of their own compensation versus the ownership, what the deferrals are from the rest of the general staff. If there is a match, it must pass some additional testing called the average contribution percentage test. The matching contribution can be funded on a per payroll or an annual basis, so once again, a little bit of flexibility there. So if you're doing the match and you're taking money out of everybody's paycheck, you can make that contribution as you go or wait until the end of the year and make those contributions prior to the time you file your income tax return. Once again, from an administrative point of view, there's typically some fee associated with an initial plan document, and some ongoing administrative fees also typically apply. So the safe harbor piece is another little nuance that makes things a little bit easier as you talk about this actual deferral percentage contribution calculation that we talked about on the previous slide. The plan, in this situation, basically what you're saying is the plan must offer a matching contribution of 100% of deferrals up to 3% of somebody's pay, similar to what we talked about in that simple plan, plus 50% of the deferrals on the next two. So in effect, if an employee is deferring 5% of their paycheck, the company will be obligated to fund 4% as a match. Or there could be a profit-sharing contribution of 3% to all eligible employees, so whether they're deferring or not. So you got that decision criteria that says, do I want to match contributions to employees who are putting their own money up, or do I just want to make a blanket contribution to all eligible employees? The safe harbor contribution is 100% vested, so something there to consider is those dollars are not subject to the vesting schedule. The plan is automatically deemed to pass the deferral percentage by the fact that you promised to make one of these two matching or profit-sharing contributions above. The new 401k safe harbor plans must have a 3-month plan year, so you've got to get those going before near the end of the year. The existing 401k plan can convert, so you've got one in place and want to add this feature. It can be done, but once again, there are some special rules and notices that apply that say everything's got to be out there by the 1st of December. So it's just one of those things that's a word to the wise that says don't think about the 401k features as you get later in the year. You want to get ahead of the curve to the best of your ability. John, back to you.
Okay, thank you, Tim. And I see we have another polling question up, so I call your attention to that. Please answer the questions. We're going to talk about cash balance plans, which is a form of a defined benefit plan. Once again, here we're talking about maximizing the amount of contribution for the dentist, the ownership group in the practice, and providing the largest deductions possible. These plans, once again, as the other plans, are all established at the business entity level. These are designed to offer the highest maximum contribution to the owners. Now, they can be turned down. You have flexibility in the design as to which level of benefit you want to fund. But typically, when you're getting into these types of plans, you want to turn it up a notch and go to the maximum. The plan contribution or funding of the plan is mandatory in good and bad years. So these types of plans are best to be established by those practices that have a consistent history of high earnings year in and year out. They're not ideal for any type of what we call one-hit wonders or whatever. We have a spectacular year one year, but you know that the practice is going to normalize back down to where it's been, and you can't afford the cash flow or the obligation to continually fund it. Then that's not the best type of design for you, because you will have to make this contribution in good years and bad years. Yes, the contribution can be frozen. Yes, it can be amended down, but you can't do that on a consistent basis. Otherwise, the Internal Revenue Service would come in and say that you really don't have a cash balance plan here. You got a quasi 401k plan, and they potentially could disqualify the plan. These plans can be combined with a 401k plan to really maximize the benefits. So you could have maximum deferrals going into the cash balance portion of the plan, and then add on the additional $17,500 of deferrals, and if you're 50 or older, the extra $5,500 that you get there. And then normally in a combined type of arrangement, we'll have an example a little bit later, there's a minimal profit sharing contribution that you could design into it of about 3 to 6% as well. Now, these plans must be in existence typically for at least 5 years is the general rule, and that's basically comprised out of various court cases. When you establish any type of retirement plan, a qualified plan, there is a statute of permanency that you must meet. That is, the IRS is saying that when you establish this plan, it is your intention to have it in place, technically forever or through the lifetime of the business. And especially in the defined benefit plan area, once again, they're looking for those folks that would just establish the plan in a few good years, try to stock as much money away, terminate it, and get the heck out of it. And they're saying no. To meet the level of permanency, you got to have this plan in existence. And like I said, through court cases, that has been determined to be at least 5 years. 10 years is really more the typical preferred time frame for these types of plans. Contributions are funded into a separate trust, similar to what Tim said on the prop sharing and so forth. And very similar to the profit sharing plan, these are pooled monies. They're not individually participant-directed type accounts as you would typically see in a 401k plan. And the reason is that it's very simple. The formula that is set up for these plans as far as funding is based on a certain level of credited interest, and the pool of money just needs to basically attain that level of earnings on a consistent basis in order to keep the contribution steady. If the amount of the earnings of the pooled account is higher than the crediting rate, well, then the amount that has to go in and be funded by the employer goes down. If the pool of money does not earn the crediting rate, then the amount that has to be funded goes up. So ideally, you want to have the monies invested in such a way that you have a good blended, consistent rate of return to keep the employer contribution rate fairly stable. The benefit's going to be the benefit at the end of the day. When you retire, that's pretty much set in stone based on the formula that's established. So the individual earnings of the fund don't have anything to do with that aspect of it. The benefits are all actuarially calculated. Like I said, it is a form of a defined benefit plan. In a defined benefit plan, you're typically funding for a set annuity payout. For example, maybe it's a pension of $1,200 a month for your lifetime. In a cash balance plan, behind the scenes, that benefit is kind of being recalculated and brought back in the form of a present value of a balance. So on the statement, it kind of looks and feels like a profit-sharing plan, where you have this hypothetical account balance that shows a beginning balance, shows the amount of the contribution allocated for that particular year, and then once again it shows the amount of the interest credit that has been applied to that account and has an ending account balance. These plans, like some of the other plans, must be established by December 31st of the year in which they're going to apply to. These types of plans, since they are a form of a defined benefit plan, have a much higher initial setup cost, annual administration, and then they cost more to terminate. So once again, when we're counseling clients about these types of plans, a typical rule of thumb is that your individual budget should be somewhere in the neighborhood of $70,000 to $75,000 as your minimal deferral. And the reason for that is that in a typical 401k type of design, if you're under 50, we typically can get you an allocation of about $52,000. If you're 50 or older with the catch-up contribution, we can get you to $57,500. In order to make the economics of the additional cost associated with these plans make sense, really we feel that you need to have at least a $75,000 or higher allocation to make that work for you. As we can see on this slide, the maximum contribution depends on your age, because it is a form of defined benefit plan. But here you can see the maximums for someone earning $200,000 a year. At age 50, you're talking about $125,000. By the time you get up to 60, it's $210,000 a year for the period of time in which that plan is established, usually funded out over a 10-year period. So we're talking about some substantial amounts of money that can be set aside for your future retirement. And as I mentioned, the account is comprised of a cash credit, which is the company contribution, and an interest-based credit based on an index. Now, these accounts can be subject to a vesting schedule, but the maximum vesting schedule is what we call a 3-year cliff. So that means the first 2 years, the employee is 0% vested in their benefit, and third year they become 100% vested. If appropriate levels of funding are maintained in the plan, distributions from the plan can come in the form of a lump sum distribution instead of an annuity, and therefore be rolled over to an IRA account. In speaking with most of the actuaries we deal with, given the low interest rate environment that we're currently in, that does not typically happen to be a problem where the plan does not maintain the appropriate funding rate. So let's summarize kind of the listing of the plans that we reviewed and their maximum plan limits. In the IRA account, as we mentioned earlier, the maximum contribution is $5,500. If you're 50 or older, You have the ability to add an additional $1,000 for a maximum of $6,500. In your SEP or Simplified Employee Pension Plan, the maximum is going to be 25% of compensation up to a maximum of $52,000. One thing we did not mention is important that the compensation level in a plan that is basically taken into account for an allocation is limited to $260,000 for 2014. So if your earnings are higher than that, the plan benefit is only based on up to the $260,000 level. For a simple plan, you can defer $12,000. If you're 50 or older, you can use the catch-up for an additional $2,500 for a maximum of $14,500. And then once again, we talked about on top of that, you can make the company will either make a 3% matching contribution or 100% match up to 3% of pay, or a 2% profit-sharing contribution. In your profit-sharing plan, it's going to be similar to the SEP plan. You can contribute 25% of compensation up to the $52,000 max. 401k plan, same limit, just going to get there through a couple different options. The sources of money, you'll have your deferral source of maximum of $17,500 deferral for 2014. Plus the $5,500 catch-up if you're 50 or older, plus the employer contribution, either in the form of a match or profit sharing or both, which could bring your total annual allocation up to $52,000 or $57,500. And then, as we just discussed in the cash balance plan, kind of sky's the limit depending on your age and the number of employees, etc. So the demographics of your particular practice will kind of dictate the maximum there. Typically, when we're doing the design, we ask you for your budget and then try to design a plan that's going to be within that budget amount of contribution that you hope to contribute on an annual basis. With that, I'm going to turn it over to Tim, and we're going to go through some examples for you. Tim?
Yeah, I think what's helpful as you go through this, there's a lot of information to absorb, and so what we did is pull some examples of some clients, obviously, on a confidential basis of some plan designs that we set in place. The first one of those is a sample of a simple plan with a matching contribution. You can kind of see here we've got a situation with one owner, their spouse who's employed by the practice, and then five employees. And basically what you can see here is that the owner and the spouse is deferring the maximum of $12,500 or $12,000 into the simple plan, plus their $2,500 deferral, plus their match, and each of them are getting a contribution of $18,520. So you can see the owners are getting roughly $37,000 into the plan, and from an employee point of view, they're putting another $3,100 in for a total of $40,000, so roughly $40,000. And you can see the owner in that situation is getting about a little better than 92% of the dollars contributed to the plan. John, back to you. Want to talk about the SEP?
Yeah, here we got a SEP plan, and basically the same demographics of the census. And here we're working with the maximum allocation, which is 25% of comp. So straight down the board, everybody's getting an allocation of $25,000 of their 25% of their compensation. So you can see in this particular situation, each of the owners in the practice are getting $33,500 for a total of $67,000. And the cost, if you will, to them of having this type of plan design and contributing for their employees is just under $20,000. So they end up with basically almost 78% of the contribution. And typically when we analyze these, we typically analyze them on a net of tax basis. So we look at what's the maximum contribution that the practice is making, what's the potential tax savings of that contribution, and then from there we subtract out the amount that's being allocated to the ownership group. And if that amount is zero or a credit, in other words, the more allocated to the ownership group than the amount of the tax savings, we know that we've kind of got a winning design. And by that, typically most of the people that we deal with, our clients, say, I'd rather have the money go to my employees rather than have it go to the government. So if we can take that tax savings amount and allocate a portion of that to the employees, and then the rest come back to you as a credit against your allocation, then that's a win-win situation, and that's what we're striving for in these designs. Back to you, Tim.
Great. As we talked on the front end, as we step up this ladder of the various examples, once again, if you kind of go back to the previous two examples, the owners are, under the simple, we're getting $37,000, and that was at 92% of the dollars. The SEP plan was basically getting them $67,000, and it was about 78%. And we take a step up here into the sample 401k with some special allocations. You can see now the owners are getting, in this situation, $113,000. And all other employees are ending up with contributions of around $5,000. So once again, you've seen the limits go up, and you've seen the flexibility go along with it. Now, typically there are annual fees that go along with that. But once again, in this situation, it's a pretty clear-cut example that says, hey, the ownership group is going to get a nice contribution, and it's going to get over 95% of the contribution dollars, which in my opinion is a pretty attractive situation. And they're doing that, as you can see above in the owners, is they're doing it part by salary deferral, part by catch-up for being over the age of 50, part by this safe harbor contribution of 3%, and then a profit-sharing allocation that's based upon compensation. So once again, as you move up the ladder, you're adding some complexity, but you're also adding some increased limits and a great deal of flexibility that goes along with it. John?
Okay. I'm just going to add one more thing to that last slide, if I could, and that is the profit-sharing allocation. We're using what's called a class allocated, and not to get too technical here, but what that does is allow us to basically allocate special percentages to each class that we set up. And if the testing works out, which ideally is that the ownership group is typically 8 to 10 years older on average than the other employees of the practice, if it'll pass a discrimination test, then we can basically leverage a higher allocation to the ownership group and put less dollars in for the rest. And that's what's happening with that particular example, and that's why we're able to get that allocation up to them to the maximum so easily. And you'll see that we use the profit sharing, we use the 3% safe harbor, and that is because we can use that as credit toward the test. If we had used the safe harbor match, we would not have been able to do that. We would have had to put some more dollars in the profit sharing. So like I said, not to be technical, but the nice thing about the class allocation as we see it in dental practices is it allows us to actually put everybody in their own class if they're a small dental practice, or larger ones we can basically use certain groupings. We can say, hey, all dentists that are owners of the practice are in one group, dentists that are non-owners go in another group, hygienists in a certain group, office manager in their own group, and the rest of the staff in their own group. And that allows you more flexibility in how much you allocate to each of those particular groups and individuals that make up that group. And the only thing in the regulations is that grouping has to be clear and understandable when it's applied to your practice as to who's being grouped in each one of those. So once again, if the demographics work out, it's a really nifty way to maximize your allocation to a plan. Last slide is once again basically taking the cash balance plan and combining it with the 401k safe harbor to really try to maximize the dollars that's going into the plan. So really basically the same demographics here. Because it's a combo plan and because there's certain limits on testing when you have a combination plan, you'll see that the profit sharing allocation to the owners is scaled back a little bit, but they're still putting their maximum $23,000 deferrals into the plan, which is the $17,500 plus the $5,500 catch-up. They're getting their 3% safe harbor and a little bit more in the profit sharing element, and they're each getting a $100,000 allocation in the cash balance. So here, they're able to put almost $260,000 into the plan for both of them in that particular plan year. The net cost to them as far as what the practice has to fund is just under $9,000. So here they're getting almost 97% of the allocation, which is just phenomenal. So those are, just kind of give you a clear example of how powerful these types of designs can be, all dependent once again upon your census and the demographics but there seems to be there's a lot of flexibility if you're working with a consultant practice like us, where we can kind of take your census and move it around and see what comes out to be the best option for you. So that's it for our presentation, and we'll answer any of the questions that have come up during the presentation, and any questions that you have now. As Dan had mentioned, please type in your questions in the Q&A section. Tim, I see one here that just come in that says a question about the administrative fees involved with each types of plan. We tried to touch on that as we went through the slides a little bit, but any of your IRA-based types of accounts are going to be minimal. So the IRA itself, a simple, a SEP, you're going to have some probably $25, $35 setup fee, maybe $50 setup fee, and an annual fee of $15 to $25 per account for those. When we get into the qualified plan designs, which is your profit sharing plan, your 401ks, obviously cash balance, there you've got a plan document that has to be set up. So typically you're talking $1,500 to $2,500 for that initial setup of that, and there may be some $100 or so annual maintenance fee on that document. And then there's going to be an annual administration fee to bring the information together, do all the testing and the allocations, and prepare the 5,500 work. And I would say, once again, depending on how big your practice is, that can range between probably $2,000 to $4,000 for a cash balance plan. That's typically it. There may be some ongoing fees potentially if you have distributions and that type of thing, but that's a general range of the fees.
Yep. John, looks like we had another question that came in and said, for a cash balance defined benefit, how much can you defer if you're age 37?
The quick answer is not much. Quite frankly, because it is a defined benefit plan, it basically is going to be funding an amount, and there are obviously limits as to the maximum amount that can be funded. The straight life annuity, that in essence is the maximum that you can be funding, is a payout on a present value basis. So you got from age 37 to 65, typically in most documents, to fund that, which is a whole lot of years. So the amount that goes in on an annual basis up front is not going to be that much until you typically get into your 50s. So in most cases, it's better to initially do a design, get you to the maximum $52,000 in a defined contribution plan, and then as you get into the mid-40s or up to close to 50, then take a look at adding a cash balance to your 401k plan, and then kind of do the flip there and kind of get into that combo plan design that we illustrated at the end.
Yeah, sounds like what you're saying then is as you get later in your careers, these become much more attractive vehicles.
Absolutely.
Next question down is, does your firm administer defined benefit plans, and if so, what are the approximate annual fees?
Well, I think we kind of went through the fees. We ourselves do not do the administration of the plans because they have to be done by an actuary, and we do not have a licensed actuary on staff. So we typically work with several different actuarial firms around the country to provide that service to our clients. Once again, like I said, depending on the size of your practice, number of employees, typically will range annual administration from $2,500 to $4,000 for a typical practice.
Yep. Next one down is if you're set up as an LLC, a disregarded entity, and effective sole proprietorship, how do you determine doctor's salary and net income? And I think maybe that's the answer to the question there. It's basically the net income of the practice. So it's revenue minus all expenses, and including depreciation, and that net number would be typically what would be allocated to the formula and the methodology you would choose.
Correct. A little more complicated than that, because with a self-employed, it's a goofy rule by the IRS, but with a self-employed individual, you also have to deduct 1/2 of your self-employment earnings off of that, or excuse me, one half of your self-employment tax off of that, and the amount of the deduction. So it becomes a circular calculation that ends up being basically about 20% of your net Schedule C income minus 1/2 of your SE tax.
Great. We have a few more minutes if those folks have additional questions. John, how about from an investment point of view? How are the investments for each plan typically handled?
Okay, as I mentioned in the IRA account type plans, IRA, simple, SEP, an IRA account is established, and usually the employees can then kind of choose whatever types of investments they want, or if they went to a specific fund company to establish the plan, say like someone like American Funds, then you typically have a choice of any of their American funds. When you get to a profit sharing plan, that's usually a pooled account, and that's going to be usually decided on by the trustees, or they can engage a wealth advisory firm to manage that pool for them. When you get to the 401k plan, that's typically going to be participant directed, and they're the plan sponsor chooses the appropriate record keeper and wealth management group to come up with a core lineup, and the participants then decide on their investments. From that, right. Cash balance, you kind of go back to the prop sharing pooled environment.
Great. This is a question I get all the time, John. It's, do I have to make contributions for employees in my practice that will only work part-time?
Yeah, well, it depends on the definition of part-time and what type of plan you have. Obviously, we tried to point that out during the presentation here, but obviously a SEP is anybody that's making $550 or more has to be included based on the eligibility criteria as far as the number of years in your document. Simple, it's $5,000. When you get up to the qualified plan, like we said, you can the most aggressive you can be is exclude somebody that's under age 21 that has not worked a full year for you and worked more than 1,000 hours during the year. That's as aggressive as you can be. You can always be more lenient, but that's it. So if somebody's, typical rule of thumb, if they're making, if they're working at least 20 hours a week, then you're going to have to cover them in the plan, even though for some, for example, health benefits, that may not be enough to be eligible.
Right. One thing that we've run into, I know, John, and clients that we've worked in over the years, but why don't you talk a little bit about some of the concerns that dentists should have if they're involved in control groups or related party entities beyond just their practice? Because there are some sort of tricks you can get yourself caught up into. Yeah,
that's a great question, and it does come up quite a bit, Dan. Sometimes we have dentists who also may have an interest in the lab that manufactures some of the dental plates and so forth. And the control group rules basically say that, if the same 5 or fewer owners own 80% of two entities, when taking like ownership into account is 50% or greater, then you have a control group, and under the regulations, those two companies are deemed to be one, and therefore all employees of both entities have to be covered and tested in the plan that's sponsored, even if only one company is sponsoring a plan. So a lot of times we get the question, well, geez, can I put it over here in this company because it's just me and a couple other dentists that are actually the employees over here, where each of our practices have a lot more employees. And once again, if the rules are that they meet the control group, the answer is no, because you're going to end up having to bring all those employees in for testing, and you would fail testing, so you have to kind of treat them all as one.
Yeah, very complex area.
Yep.
And then we're down to the last couple of minutes. It looks like we have one more question, and this relates to, I have a 401k plan in place, but it seems like each year I get a refund of some of my salary deferrals. Help me understand why that takes place.
Great question, and Dan, it kind of goes to your slide on the safe harbor versus non-safe harbor type of design. Typically, what that tells us is that your 401k plan is a traditional plan, and you're not passing the ADP test, which basically says you as a highly compensated employee of the practice can defer no more than typically 2% higher than what the non-highly compensated is deferring. So if the rest of the staff is deferring 2%, you're going to be limited to 4%. If you end up trying to defer more than that, at the end of the year when that ADP test is run, the excess amounts over that 4% in my example have to be refunded to you. Otherwise, excise taxes can apply. So that would beg to maybe be for that particular plan to consider a safe harbor design so you can maximize your benefits.
Yeah, it sounds like a great way to potentially get around that issue. So it doesn't appear we have any other questions. At this point, I think I'll turn it back over to Dan. Dan, you out there?
Yeah, great. Thanks, John, Tim, and participants. You guys covered a lot of great information today and a lot of great questions out there from our audience. If we are not able to address a specific question that you had, you can contact either of our presenters. Their contact information is on the screen right now. Thank you very much, all.